Good afternoon, and welcome to today's webinar, A Strategic Approach to Managing Student Loan Debt, hosted by IAW with our partners Laurel Road. I'm Melissa Goldberger, Vice President of Marketing at IAW, and I will serve as our moderator today. On behalf of the entire organization, I'd like to make a special welcome to our members who are joining us. For those who are not members and unaware, the International Association of Women, IAW, is a global in-person and online professional networking platform that provides nearly 1 million women the forum, education, and services to thrive in an interconnected world. IAW members have diverse backgrounds, beliefs, perspectives, and lifestyles, but with one common bond, their ability to succeed. And today's webinar will definitely set you up for success. Before I pass over to our amazing speakers, I would like to just go through some housekeeping. First, everyone is on mute. Questions. There'll definitely be time for questions, and feel free to submit them as they come to mind. You will see below the presentation box an area where you can submit questions that you have. Throughout the presentation, Alex will be and Alyssa will be happy to take them. The number one question I get: recordings of today's webinar will be emailed after the session and along with the deck. You'll be able to also access them on the Bright Talk platform anytime you wish. Well, enough about us. I am so excited about today's webinar with the team from Laurel Road. We selected Laurel Road as a partner last year to work with IAW specifically for not only because of their amazing product, but their commitment to women. So to kick us off today, I'm excited to introduce Alyssa Sheffer, the CMO for Laurel Road. Alyssa, take it away.
Great. Thanks so much, Melissa. I really appreciate it. Thank you so much for having me. And again, thank you to IAW for your partnership. So as Melissa mentioned, we recently kicked off this partnership a couple of months ago and have now been introduced to all of you. And I hope this is the start of a conversation to really talk about how we can help you with not only your student loans, but with financial awareness and advice in general. I wanted to just start off very briefly by talking about a survey that we recently launched and developed. The survey itself was actually done in conjunction with a research firm, and it was really looking at the difference between personal finance and the differences between how we manage our personal finance, specifically millennial men and women. So what the findings were, and I'll talk a little bit about them, I won't spend too much time, but I think you'll find it all very interesting because what the findings were was that women are a bit less aware of what is available to them in terms of resources and support for financial planning, so therefore they feel a little bit less confident in financial planning and financial management of their own personal finance themselves. And so what we want to do here at Laurel Road is really help change that, not only by bringing awareness to some of the differences and inequalities, but also by bringing you content and tools that really can help you take control of your personal finances and really learn more about what that means. I wanted to share just a couple of stats, and then I'll pass it off to Alex to talk a little bit more about who we are and what we do. But our study shows, and this is going to come out a little bit more widely on Monday actually, but what our study shows is that millennial women, 64% of them are significantly more stressed than their male counterparts about their finances. When you compare that to men, only 47% of men are stressed about their finances. And so that's a pretty big difference when it comes to that level of stress. And one of the reasons is because, unfortunately, we make less than men. This probably isn't a big surprise, but women coming out of college that we surveyed made about $10,000 lower on average per year than men. Another stat I wanted to share is that 88% of male millennials report taking personal finance or business finance courses in college, while only 54% of female millennials report taking finance classes in college. And these are people that are not business or finance majors, just people really trying to educate themselves on personal finance. So as I said, what we really want to do is really completely change this trend and really help women feel confident and empowered, not only in reaching their life goals and being a partner with you to do that, but also just in bringing awareness to some of these issues and some support in terms of what we can do to help you. So I will now pass it off to my colleague Alex. Alex and I have been working together for about a year now. as I've been at Laurel Road, and he has a wealth of knowledge to share when it comes to student loans and how to manage student loans, as well as the resources out there to help you make the decision if financing makes sense for you or maybe something else. So I'll pass it off to Alex now, but I just wanted to introduce myself, talk a little bit about why we're even talking about this issue and some of the differences that we found between men and women, and really our role that we see it as a bank and a financial company to really help turn around this trend. So thanks again to Melissa and IAW for having us. We hope this is everything that you want it to be in terms of learning more about financial freedom and your student loans. Again, we're here as a resource if you have questions, but thank you so much, and I'll pass it off to Alex now.
Great. Thanks, Alyssa, and thank you, Melissa, for helping us organize this. To echo both of you, we're definitely very excited to kick off this partnership and hopefully be able to shed a little bit of light on your student loan repayment options, both federal and private. And that's going to be the basic idea of this presentation today, is walking through, some of the options which exist for borrowers to repay your student loan debt. The market has certainly evolved here in the last 3 or 4 years, with both the federal programs changing and this new student loan refinancing concept coming to light. So we'll talk about both of those, some of the pros and cons, and hopefully give you an idea of which types of programs tend to suit which types of financial situations, because there's certainly no one-size-fits-all approach. So on the agenda is going to be a little bit about Laurel Road to start. I'll give you some background on our company and what we do, and an overview of those what we see as two real repayment roads to go down. So either utilizing the federal programs for their forgiveness or subsidy potential, or looking at the alternative, which is what we do at Laurel Road with the student loan refinancing and providing you lower interest rates on your educational debt. And we'll actually apply some numbers to all these ideas. So see, by locking in a lower rate, how much do you potentially stand to save, which I think will be quite eye-opening. And towards the end, placing some parameters around which of these programs suit, different types of borrowers. And the goal by the end will be to develop sort of an action plan, things you should be thinking of as you matriculate through repayments and hopefully on to growing your net worth in other ways. We do have the question functionality enabled today, so to the extent that questions came up throughout the presentation, feel free to type them in. I'll try and pause every couple slides, and Melissa will send me some questions that people have asked, and we'll also have some Q&A time at the end. So to set the stage here, a little bit of background on Laurel Road. We are an actual FDIC-insured bank with locations in Connecticut and New York City. However, we do lend nationwide, so all 50 states. We've been in the student lending arena since 2013. We were one of the first student lenders to enter this refinancing space. So we're certainly very familiar with it. We've done over $3 billion in loans to date, which is quite a bit of debt. And our average rate for borrowers is, believe it or not, just below 5%. So I'm sure plenty of you are sitting there with federal rates in the 6, 7, sometimes 8% range, and there's a good likelihood we'll be able to provide rates beneath that. And in light of the lower rates we provide, our average borrower is saving about $21,000 over the life of the loan. And that does not include any additional incentive rate discount, which you would be able to capture through our new partnership with the International Association of Women. So I'll talk more about that and exactly what the incentive is, but I can assure you it's an additional, in most cases, couple $1,000s worth of savings in light of this added incentive. An even higher level view of where we stand, I think a lot of people don't realize that student loan debt has really skyrocketed just in the last 10 years. So it's basically tripled since 2005. And where we stand today, the outstanding student loan debt in the economy is over $1.2 trillion. It's the second largest piece of debt that exists in the economy, recently surpassed credit card debt. Only piece of debt bigger is mortgage debt. And you know, for a lot of people who've taken out a graduate degree, your student loan debt could quite easily match what your mortgage amount is. So, you know, very conceivable that your student loan debt is a burden on you. And in light of that, the government's rolled out a number of programs to hopefully help alleviate, you know, that financial burden. So, as we look at the marketplace, we really see borrowers with two different options. You're utilizing those federal repayment programs, you know, potentially pursuing some type of forgiveness, or utilizing an income-driven repayment program, you know, to lower your monthly payment, or maybe capture some subsidy potential to lower the cost of your debt that way. Or you're looking at a private loan refinancer like Laurel Road to lock in a lower rate and hopefully reduce the interest costs on your debt. So, like I said, we're going to talk a bit about both of these options today, and hopefully you'll be able to walk away from this with a better understanding of which path really suits your situation. So speaking of the federal programs, I think one that's top of mind for a lot of people, especially those working at a 501c3 nonprofit or government entity, is this Public Service Loan Forgiveness Plan. So this program basically says if you work at a nonprofit or government corporation for 10 years while making qualifying payments on your loans, at the end of those 10 years, if there's any balance remaining on the debt, it gets forgiven. And this forgiveness is actually totally tax-free. So if you had, you know, hypothetically $100,000 forgiven, that $100,000 would just be wiped clean off your balance sheet with no tax implications. And I think there's a lot of misconception about this program, that you need to sign up for it or you commit to working in, you know, some type of underserved area. None of that's the case. It's all about positioning your employment and your loans such that they're eligible to be forgiven. So first and foremost, only federal direct loans are eligible for this. So if you had private loans, those can't be forgiven through this PSLF program. Secondly, you need to work at a nonprofit, like I mentioned, or for the government. So state, federal, or local government entity, any of those would qualify for this. And then you need to make on-time payments for 120 months. So 12 payments a year for 10 years. They don't need to be consecutive, however, they do need to be on time. So if you were to leave the public sector and come back, you would pick up where you left off progress-wise. So keep that in mind, you know, given some employment uncertainty. And then lastly, you need to be enrolled in one of these income-driven repayment options in order to pursue forgiveness. So you utilize income-driven repayment to pursue public service loan forgiveness if that was your ultimate goal. I would note here that there is some uncertainty as to the program's longevity as it relates to Congress. It's been proposed to limit the public service loan forgiveness amount to $57,500. So if you owed more than that, you need to keep paying for an additional 10 years, at which point the remainder of your loan debt would be forgiven. This is in contrast to how it stands today, where public service loan forgiveness is limitless. So if you know you had $100,000 forgiven after 10 years, you know there's no cap on that amount. So what I would recommend is, you know, if you're working at a nonprofit, this program is really attractive. Absolutely. You know, we don't know what's going to happen in Congress, so there's nothing wrong with pursuing it for now and keeping a very close eye on the legislative ongoings. You know, if things change, just be prepared to, you know, switch gears and perhaps look into alternative repayment programs. So one last slide about these federal programs, and then I'll take a couple questions. just talking a little bit about some of the nuances between these income-driven repayment options. So there's actually 3 different programs, and there's certainly some differences between each one of them. But the basic idea amongst all 3 is that the borrower's going to make, you as the borrower are going to make payments based solely on your discretionary income and your family size. So each of them have your monthly payment as a percentage of income. So IBR, that's the oldest of these 3 programs, it's asking for 15% of income, and then pay-as-you-earn and revised pay-as-you-earn, repay, are only asking for 10% of your income. So from a liquidity standpoint, the newer of the 3 programs, pay-as-you-earn and repay, are preferable. One other item I'd highlight on these is that there is the potential to have loan forgiveness even without working at a nonprofit by using these income-driven options. However, it's a fairly long-term forgiveness plan. IBR, you have to pay for 25 years before anything gets forgiven, and then pay-as-you-earn is 20 years. Repay is 20 years for undergraduate borrowers, and graduate degree holders, it's 25 years. So again, some nuance amongst these 3 programs. Long-term forgiveness, while certainly a viable option for plenty of people, a big factor to keep in mind is that the forgiveness through income-driven repayment is a taxable event. So, let's say you're in pay-as-you-earn for 20 years and you wind up getting $100,000 forgiven. That $100,000 is going to be added to your adjusted gross income, and you'll have to pay a tax bill on it. So it doesn't necessarily negate its value totally, but it's certainly a consideration in determining your best option. There is a cap on payments in IBR and pay-as-you-earn. That's the 10-year standard amount, so the most you would ever pay is whatever your 10-year loan payoff amount is. That does not exist for repay, though. So again, another nuance amongst the 3 programs. Repay, however, is really attractive for borrowers who have a relatively high loan debt but more modest salary. So say, for example, you came out of school owing $150,000 with a graduate degree, but your starting salary was $40 or $50K. Your monthly payment may very well not cover even all of your accrued interest. So in that instance, while using repay, half of the unpaid accrued interest is not charged to you. So hypothetically, if you were accruing $800 a month in interest, but your monthly payment was only $400, that other $400, which you're not paying, half of it is not charged. So this can be really attractive, like I said, for people with modest starting salaries, but relatively high loan debt. And then all 3 programs, there's no interest capitalization, so any unpaid interest, it's not being added back to the balance to compound and accrue more interest, which is ultimately to your benefit. And lastly, on these 3, IBR and pay-as-you-earn allow you as the borrower, if you did want to minimize your income and you were married, or minimize your payment rather, you could file your taxes separately, and they wouldn't consider your spouse's income in calculating your monthly payment. So if you had a spouse earning a meaningful salary, you could file your taxes separately and keep your monthly student loan payment directly in line with just solely your income. Repay does not present that option. So again, just one difference amongst the 3 programs. I know these are relatively nuanced, and towards the end of the presentation I'll talk about a tool that we've developed to help folks determine which repayment option best suits your situation, federal versus private, and then even taking it one step further, amongst the federal programs, which one best suits you. So I think that's probably a good time, Melissa, to take a couple questions that have come in, and then we can start talking about the alternative, which is the loan refinancing with Laurel Road.
Absolutely. There's some really amazing questions coming in, Alex. So the first question, is this for gross income? Are there any deductions?
So it's adjusted gross income. So it's your gross income less any above-the-line deductions you are eligible for, which for most people is the standard deduction.
Okay. Now, in that change to PSL, would current enrollees be grandfathered in?
That is the biggest outstanding question of all of this. We don't know. It's yet to be voted on. Very much remains to be seen. So, like I said, if you're planning on pursuing it, there's absolutely nothing wrong with that. It's an amazing program, but just keep a close eye on what happens with the legislation.
And in terms of government entities, does this include military as well?
It does, yes.
Great. So now, is it true that one would have to sign up for the PSLF when they came out of school?
So you don't necessarily sign up. They do have a form that you submit to your loan servicer indicating that you're planning on pursuing it, but it's not like a commitment, so to speak. You just simply indicate to the government that you're planning on pursuing it, but it's not as though you're signing up for anything.
That's great. We have a few more, or unless you want to keep going a little bit, we got a few more, and these are great.
Sure.
This one,
yeah.
So now, if your school was sued by the Department of Education, can any of that debt be forgiven?
That's a good question. I'm not familiar with the individual legal proceedings of Department of Ed lawsuits, so you would have to check with the Department of Ed on that.
That sounds like a really great approach. Are public school teachers and principals in this category?
Absolutely, and to be quite honest, it's those type of professionals who this program was created in mind of.
And then a nonprofit higher education institute would be able to apply to PSFL as well?
Absolutely. So most of our colleges and universities are nonprofits, so employment at any of those would qualify.
And in terms of when married, will your spouse income be considered if married filing separate?
It depends on the program. So as you can see on this slide here, if you file your taxes separately in IBR and pay as you earn, they'll only look at your income. If you file them jointly, they'll look at the household. If you use repay, regardless of how the taxes are filed, they're going to consider household income.
Okay, great. And then there was another question, and I think I know the answer to this. Will you be discussing private loans?
We certainly will. That is a perfect segue, in fact.
And I did not plant that.
No, that's a good question, and that's really what we do here at Laurel Road. Is so we seek out borrowers who have loan debt, either federal or private, with rates higher than we feel you ultimately deserve. So we look at the marketplace and see folks who've been responsible with their credits and have graduated from a four-year university and are now working in a steady job, and we believe that you deserve a lower interest rate. So what we propose to do is pay off your existing student loan debt with no cost to you whatsoever, and give you a new loan at a lower interest rate, thereby saving you money on your interest accrual over the life of the loan. So this is called student loan refinancing, same concept as refinancing a home mortgage. And quite honestly, it's the easiest way to reduce the interest costs on your educational debt. So if you're not planning on utilizing any of those federal programs that we talked about, this is really the next best alternative, and it's a guaranteed savings, right? There's not this uncertainty with legislation in Congress. We give you a set interest rate, and if that rate is lower than what you currently have, you can very safely say that you're going to save money over the life of the loan. So some things that you should think about in determining if this is for you is number one, are you able to consistently repay your loan? So are you comfortable making a full monthly payment, and you don't need to use any of those income-driven options? If you are comfortable and you are making full monthly payments, then this could very well be a good option for you. Also want to look at if you're going to stand to benefit from some of those federal forgiveness or subsidy programs I talked about earlier. Those could potentially be more attractive than refinancing for certain situations, so evaluate those before turning a federal loan. So most people have federal loans, and by refinancing, you would be turning a federal loan into a private loan, thereby giving up those federal forgiveness and subsidy programs, which some people benefit from, but a lot don't as well. And then once you have decided to refinance, you'll need to choose between a fixed or variable rate loan. We offer both. There's certain situations which warrant each type of loan. And I think overall, this refinancing decision and what type of loan you want to take should be looked at within the context of your overall financial situation. So your student loans are not in a silo by any means, but rather a piece of your financial pie. So they need to be looked at within that context. And I would just note, you can absolutely refinance some loans while pursuing forgiveness or utilizing federal programs on others. So some people have loans they want to get forgiven, and then they also have some private loans or high-rate federal loans. You can just refinance those. You're able to pick and choose which loans you want to do this with. As far as our specific program at Laurel Road, I think we have tried to set it up to be as attractive as possible for consumers. There's absolutely no fees to refinance your loans whatsoever. No prepayment penalties either. People always ask, what do I have to pay to do this? There are no costs whatsoever. So we pay off exactly what you owe. We give you a new loan for that exact amount with no origination costs. And like I mentioned earlier, our average borrower is saving over $20,000. And I'll show you a bit closer look at this in a case study, but $20,000 over the life of the loan by securing this lower rate. We do discharge our loans in the event of death or disability, so some people are worried about what would happen if either of those were to happen. Does this get passed down to your estate? It does not if you were to refinance with Laurel Road. So we discharge the loan if either of those events were to happen. Also, in the light of unpredictable financial occurrences, we offer up to 1 year of forbearance at our discretion. So if you did lose your job, you can put the loan on hold, so you can avoid making payments for up to 12 months if you were to refinance with us. And for those who are still in school, we'll honor any existing grace period you had. So if you're in your final semester of school, you'll have 6 months before you need to start repaying your loans. You can still take advantage of that 6-month grace period, even if you were to refinance with Laurel Road. And you become eligible to refinance as soon as you've signed a job offer. So even in your last semester of school, sign the contract, you can refinance then. And here I will mention the rate discount, which IAW has negotiated on all of your behalf. IAW members receive an additional 0.25%, so 0.25%, off of whatever interest rate we would have given you otherwise. So we base your interest rate on your creditworthiness, and whatever rate we would give you based on your creditworthiness, we'll take an extra 0.25 point off by virtue of being an IAW member. So here is our rate chart offering. You'll see we have terms ranging from 5 to 20 years, both fixed and variable rate loans. And the rate which you receive, like I said, will be a 0.25 point lower. So all of these rates displayed here are inclusive of both this 0.25 point rate discount for being an IAW member and a 0.25 point rate discount for making automatic payments. So by being a member and making automatic payments, which most people do anyway, because it makes this whole process a lot easier, you're shaving a 0.5 point off of your interest rate. So you can see that there's different term options, and at each term option there's a range of rates. Where you fall within those ranges is determined by your credit profile, your total debt, and your total income. Those are the factors we're looking at in underwriting these loans. So I'll pause for a second here. I know the rate is a big question on most people's minds, so I'll let you digest this for a second, and we can also take a couple questions that have come in.
Great. So we have a good number that have just come in. Some of it still goes back to the first half too. Would a Catholic charity employee qualify for the program you talked about earlier?
You would need to check with your employer. It's 501c3 nonprofits, which are entities that qualify.
Now, is any of this considered with Parent Plus loans?
Parent Plus loans can absolutely be refinanced. They cannot be forgiven, though. So I'll mention later in the presentation, Parent Plus loans are excellent candidates to be refinanced.
Awesome. I am already enrolled in IBR. Would I lose the years toward forgiveness I've accrued if I switch to from pay to repay?
You wouldn't lose the progress if you were pursuing public service loan forgiveness, but you would lose the progress if you were pursuing longer term, so the 20 or 25-year forgiveness available through income-driven repayment.
Okay. I have a graduate loan, which was a federal direct loan, and it was transitioned to Nelnet. Is this considered a private loan or a federal loan?
That's probably just a switch in loan servicer. It's very likely still a federal loan.
And can someone switch if they refinanced through something like a SOFI over to Laurel Road? Can you refinance through that? And does that get taken into account with your rate? So will it go against your rate in terms of creditworthiness?
No, you can absolutely refinance again if you've already done so with another lender. I would add that we historically have offered some of the lowest rates in the industry, so there's a good chance if you refinance with another provider, we could provide an even lower rate now, especially with the quarter-point rate discount available for IAW members.
Perfect. And then this is, I think we answered this, parent loans can be refinanced as well, right? But just not under the forgiveness. Okay. Sure. Let's see. Can a Parent Plus loan be transferred to the student by refinancing?
It's a great question. We're one of the few lenders who allow parents and students to carry out this type of transaction. So if a student so chose, they could refinance the Parent Plus loan into their name from their parents, so long as the parent co-signed on the loan.
Wow, that's cool. That's great.
Yeah.
Is it recommended to pay on biweekly basis to pay off the loan quicker?
So we make our automatic deductions on a monthly basis, but you're welcome to make overpayments at any interval you'd like. There's no prepayment penalty. So yes, that would help you pay it off quicker.
Okay. We got a lot of questions. Do you want to keep going or more questions?
Why don't I keep going, and we can address some of these at the end.
Okay, great.
So here, I think this may be the most telling slide of the presentation. It really shows the impact of securing a lower interest rate. So a borrower here has a 7% interest rate on a federal loan. They went and got a graduate degree. They've got $180K in debt, which, believe it or not, is not uncommon at all. It's, in fact, in line with plenty of borrowers we've refinanced and much more as well. So if they kept that federal rate, they'd be paying over $2,000 a month, over $25,000 a year, and in total would pay about $250,000 over the life of the loan. So this astute borrower comes to Laurel Road, and we say, based on your background and your job, we can give you a 5% rate that immediately lowers their monthly payment almost $200. And over the life of the loan, saves them almost $22,000. So this is a true apples-to-apples comparison. They had a fixed-rate loan with the federal government at 7%. We at Laurel Road give them a fixed-rate loan at 5%. They're still paying it off over the exact same amount of time, so 10 years and 10 years. But this is one of the rare circumstances where you're able to save money in the short term. So you'll see, this person's paying less every month, but they're also going to save money in the long term, right? So there's close to $22,000 in overall interest savings. So you're not changing the repayment term in this example. You're just lowering the rate, and by doing so, you save a significant amount of money. People often ask, how much lower does my rate need to be for this to make sense? There's not an easy answer to that, but what I would say is if you're able to get it lower at all, given that there's no fees whatsoever to do this, it behooves you to take advantage of the lower rate. So, if in this example it wasn't a 2% difference but a 1%, you're still saving over 10 grand. And even if it was a 0.5% difference, that could very well be $5,000, $6,000, $7,000, $8,000 worth of savings, depending on how long you're paying it off for. So, it's worth looking into, and I'll talk about the application process, which is very straightforward in the coming slides, but very much worth examining what type of rate you could get by refinancing. Which brings us to the next slide, which is how to apply. So I showed the link on a couple of previous slides, and again, this will all be distributed after the presentation, but by going to your dedicated landing page as an IAW member, it's laurelroad.com/IAW. You'll get a little bit more information about the partnership, and you'll be able to apply online and get preliminary rates in a matter of minutes. So literally, your name, your living, your address, your financial information, permission to do a soft credit check, and we'll give you preliminary rates nearly immediately. So you can get a sense very quickly of what type of rates you would qualify for and determine if this makes sense for you. If the rate's a little bit lower than you have right now, it likely makes sense to move forward. And you'll be able to get that information rather quickly through our entirely online application process. If you did determine you wanted to move forward, you thought the rates were good, you'll just need to upload a number of documents to verify everything that you'd entered, and then we'll go to work underwriting and provide you the final rates within a day or two. All in all, this whole process shouldn't take more than a couple weeks for us to pay off your existing loans and give you this new loan at a lower interest rate. So I'd mentioned previously how complex and really specific student loan repayment is to everyone's individual financial situation. So we've developed a proprietary student loan assessment tool that allows borrowers to enter in all of your information, so your income, your student loan debt information, your interest rate, what you're earning, if you're married, what your spouse is earning. And what we'll do is run all that information through this calculator, and we can model out the federal program. So if you stood to see anything forgiven, or if you were going to get any interest subsidy by utilizing those income-driven options, and then you can compare that side by side with what it would if you were to refinance. So we really try and give you the tools to make an educated decision with all of this. It's not, like I said, a one-size-fits-all approach, so we encourage you to do your homework before pursuing any type of repayment program, be it federal or private. You can access this calculator by the link at the bottom of the page here, sl.laurelroad.com/client/tool. Or if you didn't remember that, this is available in our FAQ section on our website. So as far as we know, something unique to the market. There's no other free tool like this that compares federal versus private repayment. So if you're unsure of which type of program best suited your situation, this is a great resource to take advantage of. So to sum things up, we thought it'd be helpful to kind of give some potential buckets of people who we thought stood to benefit from either federal repayment or loan refinancing. So on the federal side, you're working at a nonprofit or a government entity. And none of this is to say every one of these bullet points means that you should go one way or another, but it's an indicator that you should at least look into this. So if you worked at a nonprofit or government entity, evaluate federal loan forgiveness. If you had liquidity needs, so if your debt far exceeded your income, look at those income-driven repayment programs. See if they're able to lower your monthly obligation and maybe save you some money through interest subsidies. If you, like I said, stood to benefit from the subsidy, especially with repay, that's a very good deal, and in some cases an even lower effective interest rate than you could capture through refinancing. So evaluate that. And lastly, folks who've maybe had a hiccup or two with their credit, the federal programs tend to be the best fit, but that's not to say that down the road you couldn't look to refinancing once your credit is improved. And on the refi side, if you are not pursuing forgiveness and didn't need those income-driven options, it's a good indicator that you should try and secure a lower interest rate. That's going to be your best path to minimizing the cost of this debt. If you had private loans, nothing on the federal side applies to you. They can only be refinanced, so worth looking into for sure. And I think, this isn't to say that only people who are earning more than they owe refinance. That's certainly not the case. But if you do, let's say you're earning $100,000 and you owe 60 or 70, that is a clear indicator that you should be refinancing. None of the federal programs would benefit you in that situation. And like I mentioned earlier, Parent Plus loans, excellent candidates to be refinanced. They have very high rates. They cannot be forgiven. They are good examples of loans which are prime refi candidates. So that was all I had for you as far as the presentation today. Really appreciate everybody joining. Certainly time for some questions after. If you had individual questions, I would encourage you to take a run through that student loan assessment tool and/or contact us at studentloans@laurelroad.com or by phone at 855-245-0989. And to learn more about our partnership with the IAW and the quarter-point rate discount that we offer, you can visit our co-branded page at laurelroad.com/IAW. So again, thanks everybody for joining. And Melissa, if there's any questions, I'm happy to take them now.
We do. We have still a bunch more questions. And also just to add to your last slide, we will be emailing, again, the recording. And with that, Alex, I'll make sure that this is right front and center in the email so everybody has the information right in front of them. So please look out for that email. It usually gets sent out around 11 a.m. tomorrow. So the next question is, I have a subsidized loan through Sallie Mae Navinet, but I still be eligible?
Yeah, absolutely. You can refinance. We can refinance any educational loan. So whether it's federal, subsidized, unsubsidized, a private loan, a Perkins loan, any of those can be refinanced.
Is the one-year forbearance cumulative over the life of the loan?
Yes, so that's the total forbearance allotment over the life of the loan. You don't have to use it all at once, though. So if you use 6 months, because of one situation, and then a couple years later, need another few months, you can split it up that way.
Is the rate based on credit or other factors? My question is if you don't have any established credit, basically. That, I think it may have been answered, but.
So credit is a factor, and you'd be surprised that you do, if you have a student loan, you have a credit score. That's a piece of debt, and that's something that impacts your credit. So long as that credit score was above 660, and you've met some other factors, you should be able to qualify for loan refinancing.
Who determines if the rate is variable or fixed?
You do. So as the borrower, you'll be able to choose either a fixed or variable rate. When you apply, you don't have to indicate one way or another, but you get all of your rate offers after applying, and then you can choose both the term, so 5 through 20 years, and the type of loan, fixed or variable. You'll be able to choose that.
Great. The next question is, my federal loans offer a much longer time. If necessary for deferment, the information being presented, I'm not sure I understand the question. It just says may offer a much longer time period if necessary for, that there's a longer deferment, I guess. You can adjust.
No, that's true. That is true. So federal loans offer up to 3 years of forbearance. We offer up to 12 months. Like I said, refinancing is not for everybody. So if you're in that situation where your job may be uncertain and what you do in the future, there's some uncertainty. There's nothing wrong with continuing to use the federal programs until you have some more clarity.
Can this refinance program be used to pay off existing credit card debt?
It cannot be. However, we have a personal loan product as well, which has rates significantly below what most people's credit cards carry. So if you had credit card debt, I would encourage you to take a look at our personal loan program on our website. We could give you a loan which can then be used to pay off the credit card debt, thereby saving you some money in interest.
Okay. I am a current grad student and will not be done taking out loans for another year. Should I wait until it is done to refinance and keep up on the interest in the meantime?
Yes. So in fact, you're only able to refinance once you are in your last semester of school and have signed an employment contract. So you have no choice but to keep up with the federal loans until then, and you can refinance at that point.
How do your offerings differ from SoFi or Credible besides the 0.25% discount?
Yeah, that's a great question. So I think the most easy to understand way that we distinguish ourselves is by virtue of being an FDIC insured bank. So as a bank, we have an inherently lower cost of capital, meaning we get this money to lend at a lower rate than our non-bank competitors, like a SoFi, for example. So because we get the money cheaper, we can lend to you at a lower rate. And historically, we've been able to give borrowers some of the lowest rates in the industry. And as well as the lower rates, as a bank, we are more heavily scrutinized and regulated than our non-bank, online lender competitors. So we're audited every quarter. We have to adhere to the strictest set of client privacy and security guidelines, which I think a lot of our borrowers take satisfaction in knowing that their information is being kept as securely as possible. Whereas some of the other lenders may not have to adhere to that type of policy.
How long is the 0.25% discount good for?
It's good for the life of the loan, and it's good for as long as this partnership remains in effect for new loans, which we certainly hope goes on in perpetuity. We're very excited to work with the International Association of Women, so we hope to continue working with you guys for a long time.
Absolutely, and same here. And we will, again, we are so excited about this, and not only great content like this, but there's great information on our blog. We have a few more questions, Alex. Are you still good? We can keep going?
Absolutely. Sure.
Okay. When we enter information, and I didn't plan any of these. It's amazing. I love this. So engaged. When we enter information in the tool, are you available to see what types of loans I have?
So you have to manually enter your loans. You would enter either your total loan debt and weighted average interest rate, or you can enter in each loan individually, and we'll calculate the weighted average. That's the way that we get your loan debt is by you entering it.
Does my PSL status change if I go from one nonprofit to another?
It doesn't. You're welcome to switch nonprofits and still continue pursuing public service loan forgiveness with no hiccup in the progress.
Are there any, this is our last question, are there any options for settlement for older student loan holders approaching retirement?
I'm not sure what's meant by settlement. I would say approaching retirement is probably less relevant than where you're working. I would expect somebody approaching retirement is probably a good refinancing candidate rather than loan forgiveness, because you won't be able to pursue forgiveness if you're not working at a nonprofit. But that's probably a good situation to be run through the loan assessment tool.
Perfect. Oh, we actually had a few more comments. My husband and I filed taxes together this year. However, if we filed separately next year, would direct loans still require me to make repayments based on both our income?
Depends which program you're utilizing. So if you're using Repay, yes, they'll still look at your household income. If you use IVR or pay-as-you-earn and you filed separately, they'd only look at your individual income after filing separately.
And this one's actually for me. Is there a cost to become a member of IAW? We have different levels of membership. Information can be found on our website at iawoman.com. There are membership fees, and they range from $24 a month, and then they go up to higher levels. However, if you did attend today's webinar, you will be we've agreed, right, Alex, that anybody on today's webinar, even if you're a non-member, we'll share some information with you.
Yep.
Let's see. And then we answered that. I'm just trying to see. Sorry. I think that's it. Do we have anything else that that any final thoughts or anything, Alex, that we want to add? Alyssa, or is there anything that anybody wants to share before we sign off today?
The only thing I would, this is Alyssa, the only thing I would say is, you know, Alex went through all the information. I would say definitely take advantage of this student loan assessment tool that we have, because oftentimes what we see is people think, even if they are a nonprofit, that the forgiveness programs are going to work out for them. And the thing is they're paying their loans, they're making payments for so long, 20 or 25 years. Oftentimes they actually save money by refinancing instead of thinking of having the repayment or the forgiveness programs be their long-term solution. So just take advantage of that tool. It really is, you know, you can go through it in 10 or 15 minutes. It's super easy, and it'll give you really the right answer for you. And that's really important to realize. So if you're making payments at a certain rate amount for 20 or 25 years, oftentimes that won't actually add up and make sense. You could have actually refinanced and paid a much lower monthly payment, and therefore a lower cost of the loan over the life of the loan versus waiting for that forgiveness to pay off. So just a plug there to take advantage of that free tool. And no, I mean, we're here as a resource for IAW members. Thank you again, Melissa, for the partnership, and great job to Alex kind of walking through all the mechanics of this. I certainly could not do it, so great job to him. And you know, we're happy to take any more questions or let you all kind of go off and research this on your own.
Absolutely. And there was still one more question again about the slides. We will definitely make sure you get the slides tomorrow. That is definitely important to make sure that you get these. And again, thank you, Alyssa and Alex. I mean, this has been so far a really exciting partnership for us because, again, not only of the service you're offering to the members, but the amazing content. And what we love so much about Laurel Road is your really deep commitment towards women. I mean, you have an amazing product, amazing story. I've gone through the process of the refinancing process with you guys. It's great, very easy. But what was really, really, what really touches me is just some of the content you've been posting. So everyone on the webinar, please stay tuned. We continuously have great information coming back out from them, and it will continue to share really strong content like this. So thank you both for everything. I really appreciate it. Really great job. Thank you.
Thanks for having us.
Thanks.
Bye.